So today, it's a little bit of a history lesson because I'm going to walk you through the past 15 years of me being a personal investor, what I've went through, what I learned, what are the influences, and hopefully you can take away some stuff that might be useful for you as well. And this is actually a part 1 where I hope it'll give you the context and understanding of where I came from, because next week in part 2, I'll walk you through my actual ETF portfolio. So hopefully if you're interested in that, this video will actually give you the basis of understanding of how I got there. Hey guys, it's Sun Min and welcome back to Your Money Game, the show where we'll save, invest and feel better about money. So let's go right to the beginning, and I'll call this phase the birth of a failed trader. I started in the markets at roughly 2005, and like most young guys, I think at that point I was attracted to the idea of becoming rich. It was really as simple as that, and I think what was even more remarkable was that I started with options rather than stocks, because I was attracted to the idea of leverage and I just really wanted to maximize what little bit of money I had. So in this phase, I actually spent nearly a decade trying and failing. I tried options, I tried futures, I tried stocks, and then on top of that, I tried switching time frames, different indicators, trying to build this perfect system. While I didn't really blow up my account, I nevertheless walked away just wasting a lot of time, but also learning quite a lot of valuable lessons. Firstly, don't underestimate the emotional toll of trading actively. Chances are you've taken a loss before, so you kind of know what I mean. But if you were like me back then and trading actively, it's actually not the individual loss that really kind of makes the biggest impact. It was the cumulative emotional drain that can come because of a losing streak. Your confidence is damaged because you're not sure what's going on, your plan's not working. And finally, it will likely spill over to the other areas in your life. But in my case, it was really affecting my work. And for me, I was either worried about the losses that I was facing, or I was worried about the gains that I made and the fear of actually losing those gains. And that's where I learned the second lesson, which is to always try and protect the downside. Now this can be done in multiple ways, but I usually use a combination of 3 things. And I want to start with position sizing. And that's simply the concept of you being aware of how large a single trade or a single position is in your entire portfolio. The reason why that's critical is that if that one stock or one trade happens to fail, you don't want it to take your entire portfolio down with it. Second, if it's not some kind of super long-term buy and hold index, be sure you understand when you are going to get out. You've got to know whether the conditions of your investments has changed, or maybe the market prices themselves has proved you wrong. Which leads us to the third tool, which is the usage of stops. So if you know where you're supposed to be getting out of the trade, using a stop really helps to make sure you put the emotion out of the decision and it will be triggered automatically. And you can do that with good to cancel orders. The final major lesson of this phase is that investing is really a lot more about personal management than it is about technical knowledge. So like I mentioned, I started more as a trader, so I spent a ton of time devouring books about technical analysis and trying to build that perfect system. Or maybe for you, you could be a fundamental investor where you're scrutinizing the underlying financial metrics. And some people have figured out that perfect system for themselves, where they've got the right entry, the right exit, the right position sizing, and on top of that, and most importantly, ability to execute flawlessly. Do you find it difficult to stick to your investment plan? Let me know in the comments below. And while you're there, please take the time to hit that like button because that really supports my channel and helps me grow. Thanks. And this brings us to the second phase in my evolution, which is the transition to becoming an investor. So prior to this phase, I mentally identified myself as a trader. This really shifted unexpectedly when I read Money Master the Game by Tony Robbins. So I had always admired his work about personal development and I found his stuff useful from before. But when it came to finances, I didn't really know what to expect from the book. However, I managed to take away quite a lot of lessons from it. And one of the more important ones was when I learned about Ray Dalio and his entire concept of the all-weather portfolio. And because I was always fixated on being a short-term trader, I had never even considered having an always-on or an all-weather type of portfolio that lasts the long term. And that really got me curious, and as I dug deeper, it somehow led me towards the FIRE movement. And that's where I learned about the concepts of passive investing, index investing, financial independence, the entire community behind it, and of course that led me to multiple lessons as well. The first major thing I learned was that it dispelled my belief that to be successful in the markets, I have to trade actively. So before this, I had no concept about indexes, passive investing and all that. I wasn't aware of things like the SPIVA research that shows that active fund managers who are doing this day in and day out, the vast majority of them can't even beat the S&P 500 index over a long term. And neither did I know about the Dalbar research, which shows that individual investors consistently underperform the market. What? And on top of that, learning about the impact of fees and low-cost index investing, that was really eye-opening. The next lesson was that diversification was less about more stocks, but really about having different asset classes. Through Ray Dalio's explanation of his all-weather portfolio, I had the basis to understand how different asset classes existed and how they work together to form a portfolio. The long-term expected returns of an asset class like equities, and mostly US equities, the smoothing power of bonds, and gold's existence as an inflationary hedge. So these were just some of the basic concepts that I picked up. And the final major lesson of this phase is that understanding that the financial independence number and the 4% rule is a great baseline to build my plans on. So before this, I was just blindly chasing more money. I had no concept of a goal, and I was really just saying like, oh okay, I gotta try and get as rich as possible. And that all changed when I learned about my financial independence number, which is simply calculating what your desired lifestyle cost is and working backwards from there using the 4% rule. I can't state enough just how important this entire concept is, because it didn't just help me form a goal, but it forced me to ask the question of how much is enough? What is this life that I want to build? And I know it's not a perfect plan, and I'm not suggesting that it's a plan that would be perfect for you either, because there are a lot of critics. People are criticizing the 4% rule, they criticize the whole notion of retiring early, and all that other investment assumptions that go underneath it. So again, I just think that it's a great baseline to start from, at least for me. And that brings me to my current phase of my investment journey, which is swimming further out into the investment ocean. So it was at the previous phase when I started noticing that many in the FIRE community were really fixated with the idea that all you needed to do was invest in the S&P 500, or maybe the total US stock market, or maybe the total world stock market, and then just set it and forget it. Now, I understand the merits of keeping it simple, and I really appreciate that. So somehow it just didn't really rest well with me of the idea of being too rigid and making the assumption that the US will continue to be so dominant decades into the future. And that eventually led me down a few rabbit holes. The two rabbit holes with the biggest influence was learning about evidence-based investing or factor investing and the global macro investment landscape. So this video isn't designed to dig deep into those two concepts, but nevertheless, here are the two of my big learnings. The first is to be aware that there are major forces that are moving markets. The academic research by Pharma and French over a span of nearly 100 years has shown that over the long term, a stock's performance can be explained mostly by these things called factors. From the global macro perspective, you learn about the complicated relationship between the interest rates, US dollar, and the universe of different kind of economic indicators that points towards where the major trends are moving. Now, you don't always have to take action on all these forces, but being aware that they are out there and how they roughly influence the markets helps give you the option of whether or not you want to tweak your portfolio. And what makes it both really interesting and really challenging at the same time is my final lesson for now, and that is you have to make a choice. So what I try to do is always balance my diet of information. So I'm always conscious about one point of view and hopefully looking for another point of view that counters it. And what I realized quickly is that you find experts on both sides of the field. And both sides could be like really convincing, really charismatic, and obviously they're all super qualified in what they do. So it's easy to feel as if like you're stuck in the middle and you're entirely unsure about which direction to take. But that's why the lesson is there. Eventually, you have to make a choice. Even not doing anything is a choice as well. For example, right now, a lot of the discussion at the landscape is whether or not we are entering an inflationary environment or a deflationary environment, and that has significant impact on how certain type of stock market sectors will perform. How much I let all this information influence my own decision making on my portfolio is still something that I'm continuing to learn how to manage. And if you stay tuned till next week, you'll see how I built my ETF portfolio with all those influences which I talked about. So there are many concepts which I completely breezed through today, so I've attached a lot of links in the description below so you can dig deeper if you want to. But if you just want to ask me a question about any of them, please feel free to leave it in the comments below. Thanks for watching, guys, and taking this trip down memory lane with me. And if you got value out of this, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with that video all about my ETF portfolio. And until then, you take care and keep playing your own game.